Started now. Thanks very much for being here. As I said, I'm Lauren Kelley, CEO and founder of OPEXEngine. OPEXEngine is a cloud-based SaaS benchmarking platform for companies to compare their own financial and operating metrics against peers and market leaders and different models. Companies use it for budgeting, for planning, for diagnostics, and also for value creation. We've been operating for about 15 years now, and we were acquired at the end of last year as an independent company, part of the Bain and Company family of data companies. So excited about that, and really excited about our topic today. Believe it or not, we have lots to talk about in terms of discussing the cost of customer acquisition as a metric, as a KPI to manage your business by, and to get a better understanding of how different companies are calculating it and applying it in their own companies. So I'm super happy to have two great panelists and discussion partners here today. Ben Murray, the founder of the SaaS CFO. Welcome, Ben, and thanks for joining us. And
great
Eric,
to be here.
Yeah. And Eric Stephenson, VP of Finance at Insightly, and someone that we've worked with for quite a number of years now in his current position or in his previous position as in finance at Domo. So we'll talk a little bit about your new position. But one of the things I love about my job is, and when I started OPEXEngine, what I thought was really cool was that as the SaaS industry was exploding all over, or expanding, it was so great that it wasn't just in California and in Boston and maybe Austin or Seattle, but all over the country. And I got the opportunity to work with just great companies. And it occurred to me this morning as I was thinking about this webinar, neither one of you is in Silicon Valley or in Boston. So Eric, maybe we can start with you. How did you end up working in SaaS companies, and how did you, develop your experience with CAC?
Yeah, so thanks for having me. Good to be on the call. Yeah, so I've been doing probably subscription businesses maybe about 10 years. I spent just over 7 years at Domo, which is analytics platform, SaaS company. And then Insightly, our core product is a CRM SaaS product with several other products as well. But particularly at Domo, we were really experienced CFO at Domo. We were a very metric-driven company. So really the entire time I was there, we really tracked and followed and set goals on all different SaaS metrics, but CAC was certainly one of them that we focused on quite a bit. So and then benchmarking. I think the entire time I was there at Domo, we really focused on benchmarks, and CAC was a big one that we had a lot of benchmarks on that helped kind of guide us in all of our planning and then the process throughout the year.
Yeah, you guys were definitely a smart company, and interesting that the founder of Domo was also the founder of Omniture, and made the KPI magic number famous.
Right.
So a little bit of history there. And you're in Salt Lake City?
That's right. Yeah, I'm based just outside of Salt Lake City.
Excellent. And Ben, how did you come to have such experience based, not in Silicon Valley, but have so much experience with CAC?
Yeah. Greetings, everyone. Yeah, I'm in Denver right now, and a lot of the companies I work, they're all over, and not just California, Austin, but a lot of states, a lot coming up in Florida. But I first started in software back in probably, I think, 2004, back in the on-premise days, licensing, perpetual maintenance, and of all places, moved back to my home state of Iowa to start as a financial analyst in a business unit of a healthcare tech company. So of all places, started my software career in Iowa. So you can see it's everywhere. Software is everywhere.
Exactly. I love that. So with that, I just thought I would set the stage a little bit, and we have new 2022 benchmarks coming out shortly for our customers. And just to set the stage a little bit, I wanted to show some of the CAC benchmarks that we have, just looking at the difference between, keep doing that. I have a new computer, I apologize, with a very sensitive touch screen. So looking at the difference between enterprise SaaS companies and SMB SaaS companies, there's, SMB comes in a lot of shapes and forms. So I just selected a filter for less than 5K. But I think one of the key concepts that we want to get across is just that CAC in and of itself, there's no ideal target for CAC. It really depends on your business model, the customer set you're going after, your average contract value, and particularly in relationship to a number of other metrics like customer lifetime value, or LTV, it's sometimes known as. And I think that companies really get caught up in one specific number. And one of the things that we want to convey in this webinar is just thinking about it in terms of different kinds of models. So as a general rule of thumb, we tend to see that companies with an enterprise model may take a little bit more than a year to recover CAC in the metric called months to recover CAC, and that SMB companies typically should be under 12 months. And that's something I'm sure Ben and Eric, you've seen as well in your experience. Ben, what do you typically see in terms of differences between SMB sales and or CAC and enterprise?
Yeah, definitely. I mean, I think, the profile of your business, your go-to-market motion, inbound versus outbound, your ACV, field motion, that all matters, as far as, what benchmarks you're going to look at, because you don't want to just look at the aggregate benchmarks. So of course, a lot of benchmarks out there, but yeah, if I'm SMB, definitely looking for, say, a payback less than 6 months, and then it just depends. Maybe it could be 2 or 3 months or 1 month in enterprise, 12 months could be good. So it's all relative. It depends on the context of your organization, your ACV, and your go-to-market motion for me.
Yeah, totally. And relative is such a key word there. Eric, what have you seen?
Yeah, I would agree with Ben and just say, I think this is a great example of when you're looking at CAC, it really just depends, right? Because you could have, in your example here, you're spending $100,000 to acquire a customer, but your average deal is typically 60, 70K or 80K or whatever it might be. That's very different than you're spending here with your example. Maybe you're only spending 5 or 10K. And if you just look at CAC alone in a silo, you might think, oh, that seems pretty reasonable. That seems pretty good. But it all really just depends on your business, what kind of contracts you're selling, and then comparing it to LTV, your point there, because ultimately it's really only as good as that LTV to CAC ratio. And I know we'll talk about this later, but this is part of the reason why I do like using the CAC ratio a lot of times, because it's really easy you can calculate that CAC ratio and get a pretty good idea regardless of kind of what deal sizes you have, of how efficient you are in your spend.
Yeah, and one of the other themes that I think we want to talk about here is that it's relative, and it's also important to make sure that everybody else in the organization understands it. And a lot of times, other parts of the organization aren't quite as steeped in CAC metrics as people in finance might be, but saying, we want to see a ratio of, 4x of CAC to customer lifetime value, or 5x or 6x or whatever. That's what we're targeting to, is just really easy to convey that to the whole organization and set that as a target. So let's talk about, there's so many different terms that are floating around for people coming into this space, floating around in blogs and in the internet and in discussions, and different investors ask for different ways of calculating CAC and looking at it. And I thought before we get into how to calculate it, we should just really differentiate between some of these terms. And specifically, and maybe before we get into new and expansion CAC, let's talk about CAC and blended CAC versus fully loaded CAC. Ben, I know you teach CAC in the SaaS Academy. Do you want to take this and just talk about the definitions?
Sure. Yeah, because it can get confusing because CAC, we could think about our gross expenses, like sales and marketing expenses, which we need. And then CAC, usually we think of CAC as the cost of customer acquisition on that logo basis, so it can get a bit confusing. CAC expenses, CAC on a logo basis. But you have CAC, of course, blended CAC, which I also call the cost of ARR. So looking at our sales and marketing expenses compared to the ARR that we're bringing into our business. And then new and expansion CAC then splits that. What's the cost to acquire $1 of new ARR? And then what's the cost to acquire $1 of expansion ARR? So you can get even more detailed. And then, of course, I always argue for or debate for fully loaded CAC, make sure we have all expenses going to sales marketing. Of course, we have to allocate that. We'll get into that, so a little bit about that first bullet.
Yeah, definitely. Eric, do you have any thoughts on differences between, is CAC, are there different variations on it in terms of, let's just say new customer acquisition? Or, on the OPEXEngine side, we would argue that you should always include all the expenses associated with new acquisitions. So fully loaded, absolutely. But there are different perspectives on that.
Yeah, that's kind of my take too. I've always tracked it fully loaded, taking all sales and marketing costs. I do think it's super useful to split it out between new and expansion and upsell if you can do it. It all just depends on where you're at as a business and how you're structured. But I definitely, and I've done that, but I really like breaking it out because it gives you a good idea, because certainly most of the time, depending on your business, your CAC is going to be very different from new versus expansion. So it's good to understand, should typically be a lot less for expansion. So it's good to understand how much you're spending on each, and maybe there's one you need to focus on more than the other. So if you can do it, I think it's ideal to break it apart. And then the only other thing, just because you have like marginal CAC in here, is I think CAC, and typically, the way I've always done it is fully loaded CAC, and I've tried to break it out as best that I can. And then I think the next step too is trying to dig in the best you can, particularly in marketing, as you see, like when you're doing CAC, it's really just kind of an average ultimately. But I think it's important too to dig into different metrics to understand, like, certain channels in marketing maybe might be performing a lot better than others, and you can really kind of identify areas within your CAC that maybe you can improve on.
Yeah, one of the things that we like to say is, there's a lot of KPIs that I see sort of similar to the budget process as a, top down, bottoms up, top down, bottoms up. At the top, you want to look at the average for the whole company and compare that to peers, because that's the best way to get an apples to apples comparison, but then work it from the bottom up in cohorts, segments, customer groups, channels, so that you can identify areas. You're going to have different CAC ratios for different groups of customers, different channels, and work those so that then the average improves at the top. I think let's just be really explicit, because we have a range of people in the audience. Do you want to, Ben, explain the difference between the CAC ratio and the CAC payback period?
Sure. Yeah, CAC ratio, we're looking at, and again, sometimes I call that the cost of ARR, but that's looking at our sales and marketing expenses versus the ARR that we're bringing in the door. So it's the cost to acquire $1 of new ARR. And it's not really saying anything about, say, then how long it takes to pay back those dollars, but just, putting on a unit economic basis. And then of course the CAC payback period is then that upfront CAC cost, say on a logo basis, say it cost us $10,000 to acquire one new customer. And then how long is it taking us to pay back that 10,000? Basically, when do we come break even on that customer? So just the two nuances there.
Exactly. And so logo CAC is the cost of one customer, just the denominator is the number of new customers, whereas the CAC ratio, the denominator is new ARR.
Mm-hmm.
Would you agree with that, Eric?
Yeah, that's kind of my preference actually, is I like the ratio. I mean, I think both are valuable, but I like the ratio because one, I mean, ultimately you care about how much you're spending to get a new dollar. And in addition to that, it's a lot easier to track. I think like it's easier to conceptualize across the company. So it's like a lot of times the way we described it, and it's easy to benchmark too, at least in my mind, to say like, hey, right now we're spending $1.50 to get one new dollar of business. And it's just like really easy to align with the organization on that than trying to say, oh, well, our CAC is $30,000. Well, what does that mean? And unless they really have the complete picture, it's tough, I think, to really understand that, where it's a lot easy for me to work with sales and marketing and say, hey, our goal is to get to $1.25 this year. So we're going to spend $1.25 and we're going to get $1 of new ARR. And that's the goal. And I think it's just easy to understand and it at least makes sense to me. So.
Yeah. And I think absolutely, just reinforcing that point that on the one hand, you want to do the analytics, but on the other hand, you want to make sure you can communicate it really easily and simply to everybody so that you get everybody moving in the same direction. The other thing that I wanted to talk about a little bit is that I left out when we were talking about the difference between low ACV versus higher ACV and how CAC is relative. I think, what we see in the benchmarking is also that it's not just the ACV, and the relationship to CLV, but it's also the stage that you're at. So you could have an enterprise sales company that's selling a big subscription product, maybe $100,000, $200,000 subscription product, but they're in the early stage or under $10 million, and their CAC payback period may be, 2 years, or their CAC ratio is not as good as it will be when they're 50 million or 100 million, when they're a more mature company. And you definitely see companies, whereas SMBs tend to get to that improved ratio quicker and with less slowly. So I know, Eric, you've been through some growth in companies and seen that change. Any thoughts about that or anecdotes that you can share?
Yeah, that's why I think it is really important to measure against your peers. Because like you said, it's very different if you're early stage, say you're 15 million in ARR, like that's a lot different than 300 million or $1 billion. And certainly like beginning, you're an early stage company, you're going to burn more money. And you're trying to add sales capacity. So you're just spending more money. Your CAC is probably going to be a little bit worse than somebody that's a lot larger. But I think that's why if you really measure against your peers, it gives you a good idea of at least like, hey, here's where all my peers are at. And especially when you're early stage, you're trying to grow your business. So it makes sense. You're going to burn some money. And so I think at the same time, CAC is great too, because it helps you know, like maybe you need to step on the gas more. Because if you're not spending enough, you're not really going to be able to grow your business. So it kind of gives you that indication as well. Whereas early stage, it's like, yeah, your CAC, maybe it needs a little bit of improvement, or maybe it seems like you're spending a lot of money to get $1, but it makes sense because you're really trying to build your ARR base early on as a company.
Yeah, and one of the other aspects to it is just your, how well funded and your growth rate.
Yeah.
We do tend to see the well-run, highly funded companies, they're spending more, but they're also getting performance for it.
And that's why you see certainly that's the balancing act, that your cash and your balance sheet too. So there's always that you have to manage, but that's why you see, it's like you see these venture capital firms, like they they're willing to invest a lot of money in early stage, even though they're burning a lot of money because they see the high growth and it makes sense ultimately.
And they're usually maniacally looking at these metrics from the companies.
Yeah, 100%. Yeah.
And you deal with a lot of early stage companies. Do you see them focused on CAC?
It just depends. Yeah. Early stage, sometimes, it's too small. Say if you're a couple million ARR, 1 million, it's just too early. We're putting the framework in place, looking at it, but really not putting too much emphasis on it, just because there's not enough volume of data flowing through the business to make it meaningful. So it all depends. Typically, maybe 3, 4, 5 million. Yes, then we can develop a nice framework of metrics, and then it scales from there. But yeah, early on, it's more about their growth story. Maybe we can start seeing some patterns in retention, and not really focus too much yet on margins and sales and marketing efficiency yet.
Yeah. No, that makes sense. So in terms of calculating CAC, what do you think the first sort of thing when you come into, Eric, you've just come to a new company, and what was the first thing in terms of looking at CAC at Insightly that you thought about?
I guess that my first question was really just how it was being calculated, where some of the costs were sitting, and just understanding how the calculation has been alluded to earlier. Like, is it fully loaded? Were we including all sales and marketing? Is there something else in there? Is there something that we're peeling out? In the past, I've peeled out like our customer event that we have annually. So there's things like that can change from company to company. So that's probably the first question. And then just understanding how your company is structured and how easy it is going forward to really peel apart that CAC so that you can see maybe something different than blended. And that's always a work in progress. So that's probably the first things came to mind, is just understanding this current structure and what ability we have to break it out, and then what the formula was, I guess.
Yeah, no, that totally makes sense. And Ben, you work with lots of new companies all the time. So what are your first sort of steps when you go in?
Yeah, when we spin up the metrics framework, it's always this third bullet, your chart of accounts and cost centers. So looking at that structure, do we have everything coded to sales and marketing expenses to those cost centers? Do we have random expenses buried in the P&L? Do we not have the proper SaaS P&L set up? So that's always the first thing, is the review of the P&L, the chart of account structure, the cost center structure. So spinning up, new customers with, the metrics frameworks. And just like, say, a new CFO coming into a new business, probably the same thing you're doing, where are things, getting that financial review of where things are being placed on the P&L. And then it moves on from there, then looking at the systems, then looking at the calculations, and so on.
Definitely. So I think one of the, eternal questions is, particularly for smaller companies, is sales and marketing. If you're doing renewals within sales and marketing and you haven't split out you don't have a separate hunters in one place and farmers in another place, how do you manage that?
I think if you're, because you see that progression where early stage, maybe hunter, it's the same role. You're both, trying to sell new customers, expand existing customers, then you segment that. So I think sometimes it's very subjective. You have to talk to your leaders, like, where are you spending your time? Or it can be sometimes more objective. If you have hunters and I assign FTE codes to those personnel, and I've got folks focused on expansion and account managers, different FTE codes there. And then I can split it based on that ratio and split sales expenses. And marketing, a little harder, talking to your marketing leader. How are they spending their time? How's their budget set up for new acquisition and expansion? So usually through a lot of discussions, and sometimes it starts out very subjective.
Yeah. Eric, I can't remember when you first were at Domo, were hunters and farmers combined or separated at that point?
Yeah, I've kind of seen that evolution that Ben talked about, where it was like early on, we were kind of just, all the AEs were essentially doing the same thing. And then that evolved over several years into where then we were splitting out our hunters and farmers. So then we had separate cost centers. for those sales teams, which of course made it a lot easier. And then we kind of ended up just going through a similar exercise, even later on when we're 200 plus in ARR. We still didn't, like, the structure was definitely a lot easier to peel things out, but there was still a lot of assumptions you had to make. And so did the same thing that Ben talked about, is working with leaders, trying to understand like how much time is spent here for this department, marketing in particular too, where sometimes it's difficult for marketing to really split it out, but you can get a good sense from marketing leadership saying like, hey, yeah, our events, like, they're pretty much all targeted towards upsell, like 90% of them are focused on upsell. And we would, the other thing we would do too is look at, we would look at, especially when you're looking at demand gen, you can kind of see the MQLs that are coming in and get a sense of how many of those MQLs are, say, going towards new business, which they typically are, or how many are going to particular teams if you want to split teams out too and look at CAC by a team. So that was kind of our approach. There's certainly a lot of assumptions, but I think you can still get relatively accurate, at least give you a pretty good sense of how efficient the different businesses are, or new logo versus upsell.
Yeah, I think it's important to talk through the and maybe dig in a little bit on those assumptions, because it's easy, as you say, it's easy in the early days if all your work is towards new customer acquisition. But once you have, I've had companies that were $100 million in subscription revenue. So that means they have $100 million of existing customers, and they were putting all of sales and marketing expense into CAC. And, they've got $100 million of customers. Presumably they're associating some resource with renewing those customers, supporting them, selling to them, upselling to them. So thinking about the assumptions, some companies do it just straight by a split of, okay, we have, 20% of our revenue is new ARR and 80% is renewal and expansion. So we're going to take 20%, or we're going to, because we pay the hunters more, we're going to take 30%, but it's some metric based off of the revenue split. It sounds like your system, Eric, in terms of deciding your assumptions for allocations, were much more nuanced by really digging in a little bit to talking to sales and talking to marketing and looking at some of the activities there. Do you want to give a little more color to that, and especially in the sales organization?
Yeah, for sure. Yeah. So the exercise that I've gone through a couple of times was definitely more detailed. Like, the way I did it was, so on the sales side, I just broke out every single cost center. So I would just pull every cost center, what their costs are, the GL accounts associated with them as well. And then I would look through just my own, knowing the business well enough myself, even just first looking through each and saying like, hey, as I look at this, like, for example, we have a cost center here that is only our farmer team. So I have a pretty good idea that most of those costs in there are related to expansion or to upsell. And then I would identify the ones I had a pretty good sense of. And then the rest of them is where, I would have phone calls with the leaders and just say, hey, what, like, partner, I know that was, I think that was mentioned earlier, but like looking at partner, for example, a lot of times partner spend is maybe more geared towards enterprise level customers, but even having that conversation, talking to a sales leader, pulling some data to see new business associated with partners, going through like our ops team, even where it's a lot of times you might do 50%, but I think you can, or even like we had a cost center that was just for POCs. And so when I looked at that cost center, I talked to the leader and found out that really like 75% of the POCs were enterprise. So it was like almost all of them were going to enterprise team when I was doing this exercise for enterprise. And then on the flip side, for new logo versus upsell, a lot of the POCs were going to new business. So it was like, I was able to say, like, come up with a reasonable assumption for every single cost center, and then roll that up and then calculate CAC, based on those assumptions. And I think for the most part, I think it was definitely directionally accurate, but it was good enough that gave us a sense of what we needed to focus on in areas that maybe we needed to improve. The only challenge with it is it's not super repeatable. So it's like, if you don't have your if you don't have your company structured that way, it makes it tough, because it's kind of like an exercise I would maybe do once a year or something like that and try to refresh what I had done. But yeah, I mean, ideally it'd be nice to get to the point where you have your GL accounts, your cost center set up so it's a lot easier and you can just pull the data.
Yeah, well, it'd be nice if companies decided to, the structure of their sales organization so that you could track the metrics, but usually that's not the driving decision.
Yeah, I try to drive that, but that doesn't always work.
So Ben, I'd love to get some color from you on the, how you go into a company and figure out the assumptions when, do you base it on the revenue number, the people, I'm sure it's different from company to company.
Yeah, it's definitely different, because I think sometimes you can introduce a little bias into your numbers if you're like, well, my revenue split is this, or my bookings are this, because it's two different stories between new and expansion business. So I think what first is it's like, what's the go-to-market motion? Is it inbound, outbound, a mix? What's our ICPs? Do we target SMBs? Do we target enterprise? So for me, it's always, let's calculate aggregate, get that right, and then let's start segmenting this. And a lot of times it's based on the ICP, again, and the demographics of those ideal customer profiles. Do those differ widely, that we have to calculate metrics separately? Do we have to calculate revenue separately and not in aggregate because the demographics are so different? So I think it's understanding a lot about their go-to-market motion. And then that kind of dictates, all right, what kind of structure do we need to put in place? And then also, how is their board looking at the business? Is the executive team looking at the business and trying to manage the business? And what data do they need? Which also drives, as a CFO, what I need to implement into, say, my tech stack, my chart of accounts, and my reporting and metrics.
Definitely. No, I think that's really interesting. And the point is, it's not quick and easy. If you should pay a little bit of attention to it and dig into the assumptions, and then make sure that your chart of accounts supports that. And I think to Eric's point, check your assumptions from, over certain periods, whether it's every year or twice a year. Make sure that, because as sales organizations are always being changed slightly, or the focus of the company, in terms of the kind of customers they're going after, or the focus between new and expansion or upsells. And that brings up the question somebody asked in chat, the question about customer success, and whether you ever use that as part of any expense from customer success in CAC, but they were also talking about expansion. So I guess I would say that there is no way that customer success expense should be used in any portion of new CAC, new customer acquisition cost calculations. Would you both agree with that?
Yeah, 100%.
Yep.
Okay. So then people talk about expansion CAC, and then it can get a little more nuanced, or let's talk about customer success, and also any help or guidance you can provide on calculating expansion CAC, because there's so many different versions of expansion. Is it, we're even hearing about companies where going from a proof of concept or a prototype that is paid to a full contract counts as expansion, as compared to, I guess in my world, I would consider that just the first acquisition of the customer. Proof of concept, even if it is paid, doesn't really count and should be tracked separately, but people have different perspectives. So Eric, what do you think about tracking, and how do you figure out your assumptions on expansion CAC?
Yeah, so that's that's certainly a tricky question. And I think it depends. I mean, it really depends, like, on your organization. I think as you look at your CS, historically, I have not included CSMs in CAC other than their commission, which can be a chunk of it. If you have an organization, typically, like, so at least the companies that I've worked for, typically our CSMs, like, their primary focus was retention. And certainly there was a piece of that. There was an element upsell, and they're always trying to upsell the customers or to grow ARR. So there's certainly an element to that, but the primary focus was for them to renew our customers and, you know, to create customer satisfaction. So because of that, to me at least, like I pretty much wouldn't include that in acquisition. On another topic, which is probably another webinar, which actually you had, I think several months ago, was talking about whether CSM should be in COGS or not. But I think if you did have CSMs in COGS, then you kind of capture that in your LTV. And so then on the flip side, like with your LTV to CAC ratio, you're accounting for it anyways. But from a CAC perspective, I have not historically done it, other than the way that in the past we booked commissions, they would end up sitting within the sales. So just the commissions associated with CSMs would then sit in sales. And so because of that, it was included in our acquisition costs. But other than that, I haven't. But you might, I think, but the thing is, I think you might have a company, and there's certain organizations where they're so heavily focused on upsell, like maybe their CSM org is really focused on it, or they have a portion of their CSM org that is entirely focused on expansion. And then in that case, like I think you could peel it out. Maybe there's some sort of assumption or allocation that you could make that might make sense.
Definitely. And Ben, do you have a sort of set of assumptions that you always make, or sort of what is your forensic kit when you go in and try and figure out expansion and the costs for expansion?
Yeah, and again, it's what roles, right? Because the early stage, it could be mixed. It could be customer success, sales, tech support. So it's like, who's doing what? That's what you got to figure out first, to figure out where is that expansion duty residing. And that could be multiple roles within the org. And then where are those costs and where is those expenses being coded, so I can isolate expansion. So that's always the first thing, because early stage, it's all over the place, multiple hats. So who's doing it, what roles, so we can isolate that. And yeah, customer success, always a debate for that, you know, whether they're pure retention and up in COGS, or if they get commission and they're supposed to close contracts, close those expansion deals, then putting some of that cost down in sales. And then sometimes they're doing both. And then you do the allocation. So three common ways I see on the customer success side, but it's important to consider that in your expansion number if applicable.
Yeah. And, you know, we benchmark customer success as a separate organization, just regardless of whether it's sitting in sales or professional services or some other area. And, you know, we definitely look at, you know, I think the benchmark for the percentage of customer success expense that's allocated to COGS is something like 85% or 80% for most sizes of SaaS companies. The other thing I was going to ask about here is just if either of you have any experience on CAC with indirect channels and partner channels, and Eric, you referred to it a little bit, but I know that gets a little complicated for a lot of companies because, you know, primarily because you're not as much in control of it and you don't have as much visibility sometimes. But also SaaS companies, a lot of SaaS companies have technology relationships with, you know, partner channels are not necessarily the traditional reseller or VAR channels, but when you have a tech relationship with a company where you're passing data back and forth or passing something through APIs, do you have any experience with that, Eric? Because that gets really tricky to then calculate that into CAC.
Yeah, I don't know if I have a ton of insight there. I mean, when I was at Domo, we had a partner organization, so we were certainly utilizing a partner network. When I left, I don't know if I'd say it wasn't a huge cost, so maybe it didn't get to that level where there was a ton of scrutiny on it. But I always included it. I always included it in CAC, and if I were to dig into the details, like between expansion and new logo, or even looking at specific teams, I would kind of go through the same process and talk through with leadership and figure out like what where are we spending our money in partner? What are we getting for it? And then use that to try to allocate, but still was always including all of our partner costs in CAC.
Yeah, interesting. Okay, well, thank you, and definitely a evolving area in terms of how companies are working together. We had a number of questions as the audience was registering on calculating CAC, and being cognizant of the sales cycle, but also of different time periods. And, just even starting with the time periods, we tend to talk about calculating CAC based on, if your sales cycle is 3 months, then maybe take your sales and marketing expenses from 3 months back, 1 quarter back against new customers this period. Or if your sales cycle is a year, then take your expenses last year against new customers this year, or do it on a rolling basis. But I'd love, Ben, you set this up for a number of companies. So how do you usually look at that?
Yeah, when I look at a new SaaS company, in my forecast models, I'm calculating what I call in-month CAC. So just that 1 month CAC, 3, 6, and 12 month, and I calculate on a trailing 12 month, on a trailing X month basis, and then see what their sales cycle is. So what's that average sales cycle, to figure out which period of measurement would be the best measurement period, so we can smooth out some of that volatility, and then calculate that on a rolling basis. So yeah, really important to understand average sales cycle length, because if you're an enterprise type sale and it's 12 to 24 month sales cycle, a 3 month measurement is really not going to be, meaningful. So for this first bullet, usually you see it you see some consistency eventually in those numbers when you cut it different ways and then align it to your sales cycle.
Yeah. Eric, what have you seen?
Yeah, and I've actually done it a couple different ways, but I've done more of a trended view too, especially when you're spending very similar each quarter. So I've done it that way too, where I haven't even had any kind of offset. But the same approach that you explained is my approach too, would be, look at your sales cycle, and that's kind of how you determine, how far back, which a lot of times it is typically like a quarter, but it does certainly depends on your business, and maybe you have a really quick, like we have a faster sales cycle right now within Sightly. So it's certainly different from company to company. So yeah. And the other thing I was going to say too is, like, I think particularly with marketing, I think that's more on the marketing side. But I've even calculated it before where I've done sales same quarter, but offset the marketing spend, because the bulk of the sales expense is really commissions. It's people and commissions,
Yeah,
which is associated with in quarter new bookings. So yeah, you can look at it that way too. Although with 606, commissions kind of gets washed a little bit anyway. So, but yeah, just a thought.
Yeah, no, it's an interesting point. Although the other aspect that I think people have to think about is, if you're a growth company, typically people are hiring salespeople. So the number of salespeople you had last year is going to be different than the number you had this year. And sales often is one of the biggest expenses in the whole company. So it's significant. It's not, minor if you add 20% to the sales organization from one year to the next. So something to think about also.
Yeah, that's a good point.
So this is sort of a whole ball of wax. We may touch on it, and I have some thoughts about it, but calculating CAC in a PLG model, we all know that PLG is very popular right now in blogs and discussions. And for those who don't know, product-led growth, the concept is that you focus so much on your great product that it kind of sells itself, to put it simply. And the implication, which we actually haven't seen from our numbers, that PLG companies would spend less. I mean, intuitively, it seems like, oh, well, if the product's selling itself, then I have less expense in sales and marketing. But the reality is that whether you sell this way or you sell that way, companies still never can get away from spending money in sales and marketing. But one fundamental aspect that we find oftentimes people don't think about is if a PLG model is based on freemium, freemium is a lead gen activity. So the cost of freemium, I think, should be part of CAC. But, Ben, what do you think about that? Because some people just put all of the freemium cost, it ends up in COGS or in some other area.
Yeah, definitely the freemium have had those discussions where, the thing is like, can we isolate cost to freemium? Maybe we allocate a portion of the production hosting costs and, maybe some outbound email campaigns, things like that. And should that reside in COGS? Should you allocate that to your marketing department and have them take on that hosting cost? So I think it just, first, it's always like, how material is this? Is it worth trying to allocate this out? That comes up all the time, especially with allocation discussions, CSM, reclass discussions. So it's like, is this really material? Like, is this our major channel of acquisition? Is freemium? We push everyone free and then try to upsell them into paid programs. Then, I might put a lot of effort into that framework. But if freemium is just kind of a little piece of it, we don't pay much attention to it. That's going to dictate, how I look at that. And then PLG, that's a whole nother frontier. I'm looking at CAC with that. What do you allocate out of your R&D there?
Yeah.
Any thoughts on that, Eric?
I would agree with what Ben said. I don't know. We had a freemium model as well, and we booked the hosting expenses, which were material to marketing. To your point, Lauren, as it really was kind of a lead gen tool. So we did have a chunk of costs that went into marketing that were specifically for freemium for hosting. So. But I agree with Ben, like looking at how material it is and then whether it's worth the effort. And I don't have a ton of the product-led growth, a ton of experience or insight there, but I have certainly heard to your point, companies that are allocating a chunk of R&D to CAC, typically your sales can be a little bit less. And so that's really kind of your main engine, but.
Yeah. And it's interesting. I've noticed, the great thing about being part of Bain is just the conversations that you get exposed to. And there's a lot of discussion among bigger companies of just trying to figure out how do you track that whole virtuous life cycle for a SaaS company and the expenses, how do you manage it from a business perspective? We've all seen SaaS is all about the funnel flowing through, bringing on a new customer, and then supporting them and keeping them highly, customer satisfaction, and then renewal and expansion, and all the feedback between sales and marketing into the product organization, and ultimately making sure that that all parts of, that's the whole thing about SaaS, is that it's all the communication and the integration among all parts of the company have to be much tighter as compared to the traditional old sort of siloed marketing gathers leads, throws them over the wall to sales, closes, throws it over the wall to customer support and moves on to the next thing. That's kind of the old model, but now trying to figure out how to track the, expenses associated with all this is complicated. But with that, I want to make sure we have some time to jump into some recommendations and best practices. Eric, you just are really good at I've always loved your perspective on, working with your business partners and making sure that you're not in a finance silo, speaking of silos versus integration. Do you want to talk a little bit about your recommendations on sort of best practices and making sure that not only can you track CAC, but that you're setting the right targets?
Yeah, sure. Yeah. So, I've always found, like, for sure, finance is most successful when they have strong relationships with business partners. And so, I think it's a little bit of a balancing act. And, but I think as you establish really good relationships, then you're able to do ultimately what you want to do, which is, win. You want to succeed as a business. And so if you're aligned, then you're able to accomplish that. Where sometimes you see some orgs where finance is finance, no one wants to talk to them, or they go the other way down the hall when they see a finance person coming. But yeah, I think that the big recommendation I would, with any metric, but since we're talking about CAC, would be to get that alignment, because ultimately the whole point of all these metrics is so that you can drive your business to be more successful and to achieve the goals that you have. And so I would, and I've always historically used benchmarks and peer stuff to be able to understand, like, really, where should we be as a company? And especially when you're doing the planning at the beginning of the year, where are we now? Where are our peers? What are the benchmarks, and where do we want to get this year? Like, maybe we're using the CAC ratio, maybe we're 30 cents higher than really where we need to be. Let's cut that in half. Let's go, let's improve by 15 cents this year on CAC, get executive alignment. And then from there, you get the alignment of all your business leaders. And then you're constantly, I would do it at least quarterly, but maybe it's even monthly. And I built dashboards on this to work with sales and marketing leaders in particular, where it's just something that becomes ingrained, where it's just a thing that you're tracking, you meet on when you do BBAs and reviews, that you're always looking at that and saying, hey, we're high, what can we do? And then they get really aligned, and it becomes something that they're driving to as well. So that, to me, is what will make the metric actually meaningful and be able to help drive growth in your organization and help you utilize cash the best way possible. Yeah,
no, that's great. And it's so funny because we've been doing a review recently of, why do customers use benchmarking, since that's our business. And, we have all sorts of assumptions about what we think is the value. People use it for planning and budgeting and all these other things. But the consistent theme across the board is always, it helps us communicate with our business partners, and it helps us set targets and get everybody aligned. It's like, people don't really, it's hard to quantify that, but it's just so important, and it makes companies so much more efficient and effective. So Ben, you've done such great work with just setting up companies for success with, their chart of accounts and ability to track for this. What do you recommend in terms of best practices and moving forward on that?
Yeah, right. It just depends on the stage of your business. Are you early stage, or are you mature, where you're calculating all these already? And now we take it to the next step. For a lot of my clients, starting with number 5, let's set up the chart of accounts. Let's understand number 4, the key inputs. And then get alignment, make sure our board investors understand how we're doing this, how we're calculating. And then, then let's benchmark. And now let's provide context, historical metrics. Now we need to forecast those metrics. Where are the metrics going? So boards want that context. So I think there's an evolution, for these best practices, and it just depends on which step of the journey you're on right now.
Definitely. And one of the things we get asked a lot, particularly recently, is, investors are asking questions about, potential recession planning, or just, thinking about that. And we've been asked a number of times to look back at 2008, 2009, and what did we see there? And so I did some analysis recently, and looking at really successful companies who came through 2008, 2009, some of the early SaaS companies like HubSpot and Zendesk and Salesforce. And, Salesforce and HubSpot were both public at that time. I'm sorry, NetSuite and Salesforce were public that time. NetSuite, HubSpot and Zendesk. I don't think Zendesk had gone public at that point. But their numbers, they were presenting continual improvement of their high-level KPIs. But I know from working with a number of those companies, internally, they were doing amazing things in terms of really digging into the KPIs. So, I think HubSpot's CMO actually published some cool stuff about how, around that time, they really dug into, for example, to understand CAC and bring it down so that they could improve their numbers. They did a lot of work on looking at CAC for specific customer segments, and really found some assumptions that they had that were totally wrong in terms of profitable versus unprofitable segments, and ways that their sales organization wasn't properly aligned to go after profitable segments as compared to not profitable ones. So, and by doing that, they were able to keep their high level numbers and averages for the top line looking good. So we're, the good thing about a recession is that I think, I can't remember who famous said this, but basically, an outgoing tide exposes who's wearing a bathing suit and who's not. We've been through some high times in the industry for the past, couple of years with valuations really out there. And I think, there's lots of companies that have earned those valuations, but a lot of companies may have gamed some of the numbers, and, now's the time to really dig in, and we all come out of this. If there is any change to the economy, we come out of it much more efficient. And, I think we were talking about this earlier, and Ben, your comment was just, well, you ought to be doing that all the time.
Yeah, right. Yeah. Whether recession or high growth period, right? As a CFO, a little cynical, where it's like, we should have these frameworks in place, just like when the pandemic probably caught a lot of people off guard. Oh my gosh, now we're doing all this what if modeling, scenario modeling, so we just have to always be prepared. Maybe now, if there's a slowdown coming up, we're getting a little bit more granular. We're doing that again. What ifs, we're line itemizing things, the levers that we can tweak. If business goes a certain direction, that we're prepared, and then we're not then just in that situation trying to figure things out.
Yeah. I mean, the pandemic's a great example. I think we all came out of it with a lot of good things that we learned. And so we have time for just a couple of questions. Let's just take a look at anything that we haven't talked about. One question is just about the time frame for PLG. I mean, definitely that's a tricky one, because the investments you make in the product much earlier, even than trying to figure out your, time frames between expenses and new customers when it's just sales and marketing that you're talking about. Any thoughts about in a PLG model?
Yeah, I mean, we could talk a whole hour about that. I think, PLG, it's, what efforts, you think about R&D development in bigger companies, right? You put together business cases. How much are we going to spend to create this feature, monetize this product, new module? So kind of same thinking for PLG. What is it going to take? And, getting back to CAC, should that be allocated towards CAC? And then also downline, are we expecting, that traction to then push over to sales and marketing at some point? PLG then creates a motion for expansion, but then do we expect them to talk to a salesperson at some point? It's a hard one.
Yeah, definitely. Maybe last thoughts as we close. A question that we got actually in advance: how does CAC demonstrate the scalability of your business and your business model? Eric, you've been through that. You took a company public, so.
Yeah, I mean, I think some of it really depends, of course, on how much cash you have, right? But and how much you've been able to raise. We certainly raised quite a bit of money at Domo, but your CAC, of course, it demonstrates your ability to scale, because it's like, if you're spending too much money, obviously, to acquire a customer, then your runway is going to be very short, right? You're going to have very limited ability to really grow your business. So, and that's why it's so important. I mean, certainly is a combination of looking at what do we have cash on the balance sheet, and then doing that full, 3 to 5 year plan, and understanding if you burn at this rate, like, does it make sense? And CAC helps you, I think, to measure and monitor that, to where you're able to say, like, hey, this doesn't make sense. Like, we're spending this much to acquire a new customer. We're going to run out of money in 12 months. So maybe we need to pull this back a little bit so that we continue. And that begs the whole other question, which, of course, to grow, you got to dump money in sales and marketing. But I do think that the things that we talked about today, it's not just about looking at the CAC number. I think then it's kind of digging, it's peeling the layers off of the onion, and then figuring out there might be areas within your acquisition costs that are just really inefficient. And as you dig into it, it's like, hey, these 4 channels within marketing are terribly inefficient. And we found that out because we dug into it, we looked at the data. Or maybe this one particular team is making our CAC really terrible, and we can change some things there. Or maybe commissions. I'm always looking at commission stack. maybe commission stack, we need to make some changes there because we're spending so much money in commissions, but we still can accelerate and grow. So that's why CAC can really help you there. And I think especially when you really like dig into the details and really try to figure out like what is really making up your acquisition costs.
Absolutely. And definitely, for any of the pre-IPO companies out there, analysts are totally looking at this and digging into it. So, and, building models out to see where the investment would go. So any last thoughts, Ben, before we close up?
No, well, CAC, go-to-market pricing, there all has to be alignment there, so that's the big discussion with the founders, the board, sales and marketing, that it all comes together. So there's got to be alignment. That's where I see mismatches that, things won't scale based on, how, our CAC is, our ACV, our go-to-market motion.
Yeah, it's all relative. It's all connected. Well, thank you so much to both of you. Really appreciate your insights and your time today. And thank you to the audience for great questions.